If you're trying to improve your financial management and really better understand how to dig into your profitability and understand what leading and lagging indicators you need to focus on, be sure to watch this video. My name is Anthony Taylor. I'm the managing partner at SME Strategy. And today I'm sharing a video from one of our friends, Stephen King at GrowthForce, where he shares the 4 core decisions that strategic CEOs need to make and digs deep into pricing models, profitability models, and how you can cascade your goals to your sales team. It's a 25-minute presentation. I hope it helps you make better decisions and grow your profit in the next years to come. And I hope you enjoy.
There are 4 core decisions. The first is pricing. This will have more of an impact on your bottom line than anything else you do. This is worth spending extra time on. And the companies that have cash flow problems did not get pricing right. Once you understand pricing, then you got to go through and look at your existing book of business and figure out who are the bottom 15% of my customers or my products and services that are the lowest margin clients. Because if you've got limited resources, you'll probably want to reprice those or fire them and be able to make money on that limited resources that's on jobs that are priced right. The third is, how do you spend money to make money? How do you invest in sales and marketing to be able to get the biggest ROI? And when should you do that? And then the last is, how do you increase the productivity of your people? In a service business, payroll is your biggest expense. On average, it's more than 70% of your expenses. And so if you can get a small ROI by tweaking the productivity of those people, you'll have a profound impact on the bottom line. Now, there are other decisions. For example, cutting costs. If you want to increase profits, you can cut your health insurance. And if you do that by 10 grand, you'll make $10,000 more profit, as long as nobody quits. But there's no leverage there. It's a one-to-one relationship. And so these decisions are all about how do you get the biggest leverage in your business. The single most important decision is pricing. I can't tell you how many times sales reps come in and say, we're in a competitive situation here. If we can give them a 10% discount, I can close that deal. And we'll make it up down the line. We'll get after sales, we'll get referrals, we'll get a referenceable client. Well, if you've got a 30% gross profit and you discount your services by 10%, you have to sell 50% more business in order to make the exact same profit dollars. It's crazy. And conversely, if you can increase your prices by 10%, you can take Fridays off. And that's what the CEOs who play golf on Fridays have figured out, how to get that pricing right. This business has $100,000 worth of revenue, has a 30% margin, so they made $30,000. The sales rep, we needed that 10%. A lot of business owners think, I need the cash flow. Sure, I got people sitting on the bench. Let me keep them busy. I'd rather have some work than not. So they give that 10% discount, and now they made $20,000 profit. And in order to get back to the original full price, they have to sell 50%. They could go from $20,000 to $30,000 in gross profit. It has a profound impact on the bottom line. You want a value price, but you need to know what's the floor, what's the minimum that you can price something in order to make your profit targets. And so your first goal is your gross profit. How much gross profit do I want to make? If I want a 30% gross profit, I can add up my costs and back into that number. But you also want to take your total overhead dollars divided by your number of widgets. If you're a service business, number of billable hours. If you're in manufacturing, number of widgets you push out the door, and come up with an overhead cost per widget sold. And that'll tell you, you can't go below your gross profit target and your overhead per widget, per billable hour. And do the same thing with your profit target. If you want to make a 10% EBITDA, then what you've got to do is look at your total profit target divided by the number of billable hours in a year, all your people times their utilization, and come up with a profit target per billable hour. And this way, when the sales rep comes in, says, I need to give a 10% discount, you can make a data-driven decision to say, do I sign up this client because they are a strategic partner? Well, if I give that 10% discount, it's all going to come out of the profits per unit. If you give away more than the profit per unit, you're not covering your overhead. And that's where cash flow problems come. The second decision, once you know how to price your jobs right, and you know what that target revenue target is, then you've got to go through and identify which of the clients you should fire or reprice. We've got a couple of stories here we'll share with you. One is Liberty Pipeline. It is a pipeline services company that spun off from Enron and had a nice, healthy, high seven-figure business, but struggled with cash flow and profits. They used a factor to pay payroll, and they assume that's because it's the big energy companies are slow to pay. But when reality is, their issue was pricing. We partner with Insperity, and we're able to automate time-driven, activity-based costing by taking their labor cost divided by the timesheets and come up with a labor cost per hour paid, and then assign that automatically back inside QuickBooks for every customer, every job, every service item. So you can see profitability by customer, by job, by service item. Alan was pricing his jobs thinking he had a 20% margin because that's the industry standard, when he didn't really understand the fully loaded labor cost, the burden of all those people. He had time leakage that he wasn't including in his bid, travel time out to jobs that he was paying for and not getting paid for. He had project managers that were buried in management costs. Those are all above the line costs. And by showing him that he had 8 to 12 margins, he was able to go back to his clients and change his pricing and increase his profits. $1 million in the first year. He sold that business 3 years later for 8 figures. How? By looking at profit and loss by customer, by job, by service item, and going to those clients that have the lowest 15% margin and giving them 3 options. First, you show them the value that you're not getting paid for, the time leakage, the stuff that your service staff, who are servants, happily gave away to their clients in order to keep the client happy, especially your big clients you have to keep happy. What happens is that value goes out the door. And if you can capture the actual costs on every job to see the time and the expense of the cost of the people and what they're doing, you can go back to the client and say, I need to adjust our fee to reflect the project managers that I neglected to put in our contract the last time. I have some travel costs that I need to include in the next contract because I'm paying people to go from Spring, Texas to Louisiana to work on a pipeline. And you'll remember the next time you do a bid to include the iPads and the laptops and the extra hidden costs that should be in the bid. And what we found is 80% of the time, our clients' say yes, because they need good subs. They need a project manager. They see the value, and people make decisions to avoid risk. If you do good work, your clients are not going to want to take the risk of going to someone else. But if they have a budget problem, you can go with the second option and say, I can reduce the scope of our work and stay within your budget, but you're going to need to take over the project management. If that's what you want to do, that we can help work with your budget. Otherwise, I got to transition you to another service provider because we're not getting paid for the value that we're giving, and it doesn't work for our business. Over 80% of the times, the clients don't want to leave, and all that additional funding goes right to your bottom line. Decision 3 is, how do you invest to make money? This is really hard. Marketing expense is not just clear. So what we suggest, you can do it at a macro level and look at what is the lifetime value of your customers. You look at that profit margin that they make and multiply it by the amount of time they're going to be with you, years or months. Then compare that to what does it cost to acquire a new customer? And that's a really important data point when you're making sales and marketing decisions, because you got to look at the ROI by seeing what does it cost versus what is it worth. The cost to acquire a customer is really simple math. You take all your sales and marketing expenses, and in your chart of accounts, that should just add up to total sales, separate from marketing because they're different. Take that total expense, which includes all the salaries, all the taxes, all the commissions, all the fees that you pay for search engine optimization, for hosting of your website, everything related to sales and marketing, divided by the number of new clients you're going to get in a year. That'll give you a cost to acquire one new client. If you get a lot of business from existing clients, you can do the same math and see if you can allocate some of those costs. And what that does is it shows you what's the break-even point. What's the point that when you get a new customer, the profit that you make on that customer covers the cost to acquire that customer. And then when you know that, then what you can do is go into the accounting system most people are using QuickBooks, you can go in and add a custom field on the customer record in any accounting system to be able to start running your gross profit reports based on the decisions you're trying to make. You're trying to decide whether or not you should sponsor a trade show, add a field in the accounting system that says lead source. You can then run your client profitability report by lead source and see which lead sources generate the most profits. We know now from decision one that not all sales reps are created equal. Some of them are selling value and able to add an extra 10%. Others only see you as a commodity and they don't understand how to sell that value. So they're the ones coming in and asking for that 10% discount. When you're going to hire a new sales rep, run that profit and loss by sales rep report. And now you can see who are the ones that are worth replicating and should train the new ones. Marketing wants to know what goes on the homepage, figure out what profitability by industry. And I love this story because Art Saxby is a Vistage sponsor and a client of GrowthForce. He has no accounting staff. We do everything, billing, collections, bill payment, financial reports, everything. But my favorite story here is that he's got outsourced chief marketing officers all across the country, 65 of them. And we picked him up at the very beginning when we just designed his QuickBooks system, when Art started Chief Outsiders. And we worked all the way through to helping him be able to have actionable financial intelligence. But one of the decision 3 that he made was, I got a bill, this is 3 years ago, from Vistage to be a platinum sponsor again. It's a big bill, 6 figures. We're a partnership for tax purposes. And I don't have 6 figures of cash in the bank because we distributed it out at Christmas. And so I'm going to pass on sponsoring. But before I do, I thought, can you guys tell me how much revenue we got from our Vistage sponsorship last year? And we emailed back and said, yes. But he was asking the wrong question. He should have been asking, how much profit did I get from my Vistage sponsorship? And he got 4 times more profit from his Vistage Platinum sponsorship than anything else that he did. He's like, oh my God, I almost didn't do that. My gut told me the timing's not right, but his data told him he needed to double down. And so now you can use that actionable financial intelligence to help make sure you don't make that decision to lose your biggest opportunity for sponsorship. And the last decision, and my favorite, is how do you increase the productivity of your people? In a service business, it's the biggest expense by far, 70, 80%. In a manufacturing business, it's the second biggest expense. So what you do is you want to make a shift from looking at your people as an expense to as an asset. If something's an expense, you want to pay as little and have the cheapest health insurance and hire late and fire fast and just cut that cost as much as you can. Whereas if people are an asset, what do you want when you invest in a stock? You want to see that stock grow. You want to see the stock price go up. You want to get a dividend back. And that's what happens when you think of your people as an asset. You want to identify who are the ideal people. What are the behaviors? Recruit for those behaviors. And then how do you give them clear written goals? And then reward and recognize the people who achieve the goals. There's 2 hours a day that are being wasted by the average employee across the United States. Most Vistage CEOs say to me, that's it? Have you been in my office? Nothing happens before lunch. And the numbers are staggering. In 15 minutes a day, 5 days a week is an hour and a quarter. On a 40-hour work week, that's 3.125% of the whole week. If you're a $3.2 million business, 15 minutes a day translates to $100,000 for each $3.2 million in revenue you got, for each 15 minutes a day that you get back in discretionary effort. Now, you're never going to get back the whole 2 hours. You don't want to. People join companies and they quit bosses, and you want your bosses to have time to relate to their employees as people. But what you can do is understand that the single biggest reason why they're slacking, and therefore you have an opportunity to get back 1 out of those 2 hours every day, is because they're not being challenged. We give them an 8-hour job. People are smart. They get into a routine, get the work done in 6 hours, and now we can focus on fantasy football and the shopping on Amazon for the holidays. And so Harvard did a landmark case study and said, you can you can increase your likelihood of success by 82% by the simple act of writing down goals. And if you cascade those goals down to the department, and from the department down to the team and each individual, what will happen is you're going to get discretionary effort from your staff. You're going to get one of those 2 hours that they've got free working on these goals. Why? Well, surprised me when I read the report was because of Maslow's hierarchy of needs. We all have a need to be part of something bigger than ourselves. And when you feel like you're part of a team, you're not going to let the team down. And so by having a budget and cascading that budget to the department, and then looking at the activities that are needed to be successful on each team for each person, and you put that in writing right above their desk, and they walk past the copier with their coffee, sit down in their cube, they can see what success is, then you're going to get discretionary effort. And if you measure and reward and you recognize, more even important than reward is recognition by the boss, then you're going to get them to start acting like owners. That's a whole separate session. We'll come back to that. But we do have a client with Insperity that was in that exact case. Their IT consulting company, similar to Liberty, high six-figure revenue, struggling with profits and cash flow as a result. And we implemented job costing to see that their biggest client was their worst client, their lowest margin client. In fact, it wasn't even covering its reflective share of the overhead costs. It was a giant technology company, one of the big ones. They were proud of it. It's on their website. But it took us 6 months to talk about, we have to go back to them and tell them of all the value that you're giving away and all the costs that were missed in their contract. And they were afraid if we lose this big contract, it'll kill our profits. When in fact, we showed them the opposite. You can take those resources and put them on new business that's priced right. So they went back and they showed the big giant technology company what the real value was. And they said, oh, yes, sure, of course, we need to pay for those project management costs and investments in your technology. They had increased their profits by over $1 million in 6 months. And then in the next year, they repriced everybody, and now they've doubled both their top line and now their bottom line. So that takes us to, how do you do that? Well, you have to have actionable financial intelligence at your fingertips when you're trying to make data-driven decisions. So how do you do that? Let's share some of the best practices that we've developed over 30 years about how do you build key performance indicators. The first is you need to track one driver per scorecard on the left axis. You don't want to have, some people say, Steve, show me the sales and the number of sales reps or the number of offices we opened on one chart. That makes the x-axis go too big, and that eliminates the shark teeth. We want to see the ups and downs, the change that happens over time in minute detail. The second best practice is you need to have a budget. If you don't have a budget, not only are you not motivating your staff to give you discretionary effort because they feel like they're part of a team, but you're missing half the value of your reports. The reports are not just about what were the actual results. The reports are also, how did that compare against what your expectations were for that same period? The budget versus the actual. In our charts, and this is coming out, this is a chart that comes out of our KPI template, and it shows you the budget, the actual, and it shows you the trend, the direction that's happening. And what it also shows you is actual results with trailing 12 months. Now, if you walk away with one thing today, it should be, what is trailing 12 months? Because most businesses have some seasonality. And at the very least, you don't have an accounting department that's really closing the books every month and making sure that that P&L is accurate. There's a lot of things that throw it off. Even if you've got a good accrual system, if you've got biweekly payroll, twice a year, you got 3 payrolls. Can't tell you how many businesses I see say profit, 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 loss, profit, 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 loss. It's like, what happened here? Oh, we had 3 payrolls. Well, that's not an accurate reflection of that month. You didn't hire any more people. They didn't work any more hours. It's just the timing of a monthly close. And what happens is that income statement is wrong those 2 months because payroll is off by 50%. You got an extra payroll. And the other 10 months are wrong because you're missing 2 payrolls. And so what we recommend is if you don't have that clear cutoff, use trailing 12 months. It's an XY chart where every dot on the chart shows you the total for the prior 12 months. So in this case, this business was a $3 million business in July 2017 and a $3.6 million business in June 2016. And the difference from month to month is the difference between the month that got added, in this case, August 2017, and the month that got dropped off, August 2016, 13 months ago. And so as that's going up, you'll see that the months that get added are getting better or worse than the month that got dropped off. But what happens here is it takes out of account all the seasonality. If you've got any aberrations from month to month, you can see the true economic result when you use trailing 12 months. And there's some really great examples here about how different it is. This is an actual business that looks like they're doing really well because that chart has a nice trend line. But what happens is when you're in your actual results, month to month results, the trend line is going to be a direct relationship between the highest number and the lowest number and the timing of that. And if you have a big Christmas season, you're going to show a big profit, in this case in October, because they had a Halloween business, I guess. As that big dot moves left, that chart gets worse and worse. And that may or may not be the truth. Whereas if you look at trailing 12 months net income, it is the truth. This is exactly what happened. These guys are actually in trouble. They've gone down from 1.5 million to 200,000 was their low in August. And they really need to look at that overhead cost. We also recommend you look at trailing 3 months. Trailing 3 months is a leading indicator of your trailing 12 months. Trailing 3 months is what you would expect. It's the last 3 months total. In this case, it shows you the last 3 months of net income. And when that light gray line is below trailing 12 months, your TTM is going to go down. And when that trailing 3 months goes above, you're going to start to see your trailing 12 months go up. And that's important because trailing 12 months, it's a 2-year trend. This is a data point for the year ending July 17, and this is a data point for a year later, June 18. So this trend line shows you what's happening as last year compared to this year. It's slow to move that big of a driver. And so trailing 3 months will help you see, all right, are the decisions that I made over the last 2 or 3 months helping us get better? And we show all that in our one-page company scorecard. We've got this document that we deliver to our clients and we give it away to our prospects and so that you can start to look at the most important drivers of your business. Every business needs to pay attention to 5 things: gross revenue dollars, which is your top line revenue, what you earned, regardless of whether you build it or collect it. Your gross profit, as we talked about, is the profit that you make on that dollars, and your net income. Those 3 drivers, we suggest you add to that the gross profit percent and the net income percent. Why? Because you may be growing the top line and the gross profit dollars and even the net income dollars, but if you're not operating as efficiently as you should be, if you're growing your people and you're not onboarding them quickly, you can still grow your dollars in gross profit, but your gross profit percentage will show that it's going down. And you're not as efficient with this new business, with these new employees as you should be. And that helps you figure out where do you invest in training and career development and help you increase that productivity of the people. We suggest that you look at your company scorecard both from an actual scorecard with trailing 12 months side by side, because you need to see both. You need to see the top, you need to see the actual results and the macro direction. So let's look at it. Our gross revenue charts show you on the left-hand side how does revenue compare to plan? And you can see that the green line is growing, the actual results are growing faster than the budget was projected to be. And on a month-to-month basis, the end of the year is better than the beginning of the year. So that line looks good. In this trailing 12, in this case, the trailing 12 months trend is the same. You can see that they've grown from $3 million to $3.5 million, and they're actually exceeding their planned budget for gross revenue for the last 3 months. What I like about these charts is it shows you the impact of turnover on your business. Turnover is one of the biggest expenses you've got. And there's no line item on the P&L that says employee turnover expense, but it can cost you 100% of the salary when somebody walks out the door. And so what we suggest is you look at the gross profit line on the actual results to be able to see if you are a service business and you make money on someone's time, then you will see that when somebody leaves, you've lost that billable opportunity, and the new person doesn't know where the supply room is yet. And so your gross profit percentage will start to go down. And if you, on the flip side, if you invest in the training of your people, or you invest in an ERP system or automation to help your people be more efficient, you'll see that gross profit percentage go up. And so I like gross profit because the most important number is gross profit percentage, because it helps you be able to see the effect of all the decisions that you make. The next the next report that we suggest is your net income. This is the bottom line that tells you how well are you managing the overhead of your costs, your gross profit minus your indirect expenses. And this chart is an actual chart, and it shows another example of where you have a company. If you look here on the left-hand side, they've got a lot of shark teeth. It's up, it's down, it's up, it's down, it's up, it's down. That makes it almost impossible to figure out what's going on. And this is because they don't have a good month-end close. They have biweekly payrolls. They don't accrue for revenue at the end of each month. Whereas you look at the trailing 12 months and it shows you the true story, what's really happened, regardless of how many payrolls, regardless of whether you accrued revenue and you did your billing on time, over a 2-year period, this will show you exactly what's happening. And oftentimes what I see is revenue is going in the right direction, gross profit is going in the right direction, but net income trailing 12 months is not. And it's because they're not getting the ROI from the salespeople that they were expecting.